Good evening or afternoon, depending on where you are in the country today, and welcome to the Appella Mid-Year Market Review. My name is Jason Gentile, Chief Wealth Officer here at Appella Wealth, and today we're going to take a look back at all the themes, issues, challenges, and excitement of the first half of 2026. We're going to cover a lot of different topics today, but we also want to hear from you. So please use the Q&A function throughout today's presentation to submit any topics, questions you might have, or like us to cover. As a reminder, we are recording today's webinar, as we always do. You'll get an email next week, kind of mid to late week next week. We hope that this information is valuable and actionable for you, but we want to make sure that this is benefiting all the people that you know, love, and care about. So, our mission here is to educate and inform as many people as possible. So please take that extra step and share this with friends, family, coworkers, anybody who might benefit from this education. Speaking of education, please go to our website, appellawealth.com, and check out our events tab to see what's coming and to watch any of our previous sessions. We've had some great sessions over the past few months. Topics about difficult life transitions, estate planning topics. There's a whole great sessions, bunch of recordings on there for you to go watch. There's also a lot of exciting topics coming for the rest of the year. So on that events tab, you'll get to see all the things that we've got scheduled for the rest of 2026 and into early 2027. So check that out. If you are new to Appella and you'd like to speak to an advisor after this session, also on our website, there's a button for contacting us. Please reach out. We'd love to speak with you and help in any way that we can. All right, so let's get on to the main event of the evening. Our favorite speaker is back with us today from Dimensional Fund Advisors. I'd like to welcome Apollo Lupescu. Apollo has been with Dimensional for just about forever, if I'm rounding up. DFA recently crossed $1 trillion in assets under management, one of our favorite firms to work with, as Apollo is one of our favorite people to work with, as he's just got this incredible knack for taking really, really challenging and difficult concepts and questions and making them understandable for even people like me. So really appreciate having you back here, Apollo. We love having you, and thanks for joining us again tonight.
Great, Jason. Great to see you. Thank you so much for the invitation to be part of this, and thanks to everyone who took the time to watch this. I mean, I'm excited. I always love our conversations because I do find that you're just a great advisor, and it's fun to talk to you.
Well, I appreciate that, and I know we've got hundreds of people on here anxiously awaiting some answers on what the heck is going on in the world.
Yeah.
So let's just kind of dive into question number one here. And once again, please kind of use the Q&A function to answer or to ask any questions that you have through here, the chat function. So Apollo, we're roughly a little over halfway through what I think has been a relatively eventful year, right? War, leadership change at the Fed. We've got maybe resurgent inflation, some news around AI, Supreme Court, et cetera. If you were going to kind of take a look back at the scorecard for 2026, how are we looking? And, as you kind of look at the data, any lessons or anything we can glean as we go into the second half of this calendar year?
Yeah, and it's so interesting because, as you said, there's a lot that happened, and you go back to the beginning of the year in January. Like I remember, like wow, we went into a different country and kind of poached the president, brought him to the U.S. That was like a lifetime ago. So all these things have happened. So what's interesting about the markets is that if you look at the first quarter, and I think that's when we left it off, we were down. We were down about 4.3% in the U.S. stock market, as measured by this group of stocks called the S&P 500. These are the largest 500 companies in the U.S. Market and economy, for that matter. And what we kind of remarked, which is so interesting, is that if you look at 2025, when we had other anxieties, we had a new administration, we had tariffs to deal with. For the first quarter of 2025, remarkably enough, we had exactly the same performance, negative 4.3%. And what happened in 2025 is that we had Q2, Q3, and Q4 positive. So over the course of the entire year, we ended up significantly above the long-term market average. So it was a great year for investors. And it turns out that this year we're kind of repeating a bit that pattern because Q1 was negative, Q2 was actually significantly positive,
Mhm.
15.2%. So we did make up the losses and we are ahead. And if you go through the end of June, a couple of weeks ago, what you see is that the US stock market is up about 10.2%. And to put some context, if you look at the long-term average per year, that tends to be about 10%. So we got that annual average over 6 months. So which is really great news for investors. We have had a tremendous 6 months, despite all the things that you might have heard on the news. And one of the things that we kept talking about here is that when you look at what drove the performance to get to this 10%, well, it's a combination of the underlying results of 500 different stocks. And if you take a bit of a deeper look, what you see is that roughly about 62% of these 500 companies in the S&P 500, so roughly about 300 companies out of the 500, made you money. They went up in value and they had a positive performance, positive return. About 38% lost money, so you had a negative return. So not every company made money, not every company lost money, but certainly more companies made money than lost money. And the interesting thing is when people ask, well, what worked in the market? What sectors, what was good in the market? It's not that easy to answer because you take companies that might be very similar to each other at a first glance. So you take Bank of America and Wells Fargo. Well, Bank of America was in the positive column, Wells Fargo in the negative. You take Home Depot and Lowe's, both home improvement stores. Lowe's was in the negative, Home Depot was in the positive. Verizon was positive for the first 6 months. T-Mobile was negative. And probably the ultimate example, Coke versus Pepsi. Coke was positive, Pepsi negative. So what drove the market is not necessarily one big theme because even within very comparable companies, some were positive, some were negative. So the lessons here is that first of all, it's not really possible to predict in advance because even very similar companies might end up on the in different buckets here. But secondly, is that the market's driven much more by individual companies rather than saying banking or home improvement or mobile cellular providers or beverages. And if you want to take even a deeper look, you could actually take these and break them down by how much, not just the fact that some companies went up and down, but by how much. And if you do that, what you see is that 94 companies out of the S&P 500, so about 94 out of 500, went up in value between 10 and 20%. That's the increase in value. We had 80 of those companies, 80 stocks that went up between 0 and 10%. So this range of 0 to 20% had more than a third of the stocks in the S&P. So more than a third were in the range of 0 to 20%. Now, that's the most common sort of range of performance. And if you go now more to the extremes, let's start with a negative extreme. There were 16 stocks, and not nearly as many, that had almost like extreme negative outcomes in the sense that they lost 40% or more of their value. And the question is, well, what were those companies? There was some software, Adobe and Intuit. Obviously, we know Photoshop and TurboTax, but not necessarily only software. If you go through an airport security, there's a machine likely made by a company called Leidos. Next time, pay attention. Look at that. It's Leidos. And that was down about 40+%. Accenture, the consulting firm, down over 50%. And Lululemon, the clothing company, down 45%. So not exactly, all of them in a certain bucket, all over the place. And the really good news also for investors, when you look at the extreme positive, extreme meaning that over 40% increase in value, we had 3 times as many companies. 48 different stocks went up in value over 40%. So what were those stocks? Well, the first, and I can put anybody on the spot, but I'm not going to do it. If you think of what the best performing stock, it has to do with cameras. Well, in my mind, because it's a memory card that goes into cameras that I used to buy from a company called SanDisk. And the market's up about 10% for the first 6 months. So let's start there. And if you think of SanDisk, the best performing stock for the first 6 months, Jason, I'm going to put you on the spot. Any guesses what the performance might have been? Well, the market was up 10%. What do you
Yeah.
think SanDisk did?
All right, I'll say 2x that, so 20%.
Try 857%.
If you round up, I was pretty close.
You're
So
over. I mean, I was blown away when I saw that over 800% in
yeah,
6 months. You had Intel up 278% over the first 6 months, but not just chip companies. You had Moderna, the vaccine maker, up over
wow.
130%. You had DaVita Dialysis. My dad used to frequent that establishment, and that stock was up 95%. United Rentals up about 40 plus percent. You had Caterpillar up 60, 70%. So you had great performance coming from all variety of sectors. And I think this is a really good lesson. It's not that the market was driven and concentrated by a handful of stocks, but really it was a variety and not easy to pinpoint. Now, ultimately, from these 500 numbers, we get to a single one, and that single number, as you know, it's the S&P 500, 10.2%. And at that point, to get from the 500 to the single number, as we talked before, you also have to account not just for the performance of the companies, but how big they are. What's their value in the U.S. market? Something called capitalization. How many shares of ownership, and then how much is each share worth it? You multiply and you get a sense of the value of the company. And the way we measure performance as investors, we emphasize more the larger stocks. The larger the company, the greater the emphasis on its performance relative to a smaller one. And that's why
Mm.
these Magnificent Seven that you hear so much about are so relevant, not only because they have, just great AI and technology and blah, blah, all that jazz, but they're some of the biggest stocks in the US market. So if you look at the first quarter, you remember the market was down about 4%. These Magnificent Seven were down about 11%, significantly more than the market. And for Q2, the market was also up, and they went up as well, not as much as the market, but they made up the losses. So by mid-year, these Magnificent Seven are basically flat. There's nothing to talk about. They just basically no growth. They're very flat. And they left a hole in the S&P. So if you look at the S&P 500 minus these seven stocks, let's call it the S&P 493, that group of stocks, the market, except for these seven, also went up, but by 15.6%. So in other words, the market did really, really well compared to the Magnificent Seven. And in fact, the Magnificent Seven somehow detracted significantly. Without them, the market was 15.6. When you add the Magnificent Seven, you get to 10.2%. So the Mag 7 were a drag on performance. And the reason they were such a drag was because among the seven of them, as we've talked in the past, they amount to about a third of the value of the S&P. So about a third of the performance of the S&P is driven by these seven stocks. And as we mentioned in the past, they're also part of NASDAQ, but not at 32. They're actually a much greater 47% of NASDAQ, almost half of NASDAQ, driven by seven stocks. And they're also part of the a global portfolio, something that Apella would do. You're not missing out on them, but you're not as concentrated. So this particular period, I think that we can talk and say, great. I mean, this really played out well. The global portfolio, by not being over allocated to these Magnificent Seven, outperformed the S&P. I'm sure there'll be other periods when it will flip. But I think the fundamental premise here is number one is that you're not missing out. You have these Mag 7. Number two, there was a benefit this particular period from not being over concentrated. And the third point is that if you look at the performance of NASDAQ or the S&P, it is likely to be different than what you see on an Appella statement because Appella did not miss out, but it really tried to mitigate this hyper concentration that you see in other indices, market indices, and that's a good thing in my opinion. It's just that by design, almost it's not designed to match exactly the performance of Nasdaq or S&P. So right now it's cheery and great. There'll be times maybe it's flipped, but the bottom line is that you should understand why your performance might be different than what's on the news.
If we take a quick tour around the rest of the globe, what like international emerging fixed income, got a quick thought on how the rest of the world did?
Yeah, so the rest of the world actually did really, really well. We had the international developed markets, they're up about 9.2%. And that is pretty much, it's a great result. Again, the long-term average is about 10%.
Yeah.
And within that, we had fantastic performers. And among them, number one was Netherlands. And that market was up about 38%.
Wow.
And then you had Austria and even Israel, like despite all the challenge in the Middle East, the Israeli market did pretty much exactly like the US market, about 10%. And at the lower end of these international developed markets, there are two countries with negative performance. It was the German stock market and the
Hmm.
Danish stock market, but it was -1 and -2%. So very not much of a change. Well, what I found interesting is emerging markets, because emerging markets as a whole was up about 23% or so, 23, 24%. So twice as much as the US market. But what I found it remarkable is the countries that drove that. And one of them, the best performing stock market in the world for the first 6 months was the Korean stock market. And that was up 104%, more than
Wow.
double in 6 months. And then right behind it was Taiwan. There was about 62%. And then on the lower end, the two that didn't do so well, China down about 15%, and a
Mhm.
small part of the portfolio in Indonesia that was down more than that. So it was an interesting year because once again there was a benefit from being globally diversified. Individual markets were all over the place, but the one that you should know is that Korea just crushed it, and Taiwan also crushed it, and to the point where because of the recent performance, the Taiwanese market is actually bigger than the Chinese market. So I'm not getting into geopolitics, but it is interesting
Oh,
to see that the Chinese market is not as big as the Taiwanese one.
that's unbelievable.
Yeah.
I always think back, you've always produced this piece of the kind of periodic table, and when you look at all the countries, no discernible pattern, as you
Yeah.
just mentioned there, right? You never know what country is going to lead on a year-over-year basis.
But what you can say is that a lot of these countries, they're not really countries as much as you have to think of them as companies that are based there.
Yeah.
And we've made the point in the past that you look at NVIDIA, it's the poster child of success in AI. Well, NVIDIA relies almost exclusively for their highest end AI chips on Taiwan and Taiwan Semiconductor Manufacturing Corporation, TSMC. TSMC is roughly half the size of the Taiwanese market.
Yeah.
And then in those factories, there's a machine made in the Netherlands that is incredibly sophisticated. And there's only one company in the world that can make it, and that's an investment in the Netherlands, and the company is ASML. So it is interesting and ASML is a very big part of the Dutch market as well. So when you look at the performance of markets, again, you have to think that, hey, TSMC is a huge chunk of the Taiwanese market. ASML is a big chunk of the Dutch market. And in this AI global value chain, they're participating as much as NVIDIA. And if you look at the performance of these countries, as I kind of mentioned, yes, the US comprehensively did well. But look, as I mentioned, Netherlands just, significantly outperformed us, and so did Taiwan. And the association here is that it's not the country, it's the companies
Yeah.
that really drove this. And these are companies that are global in nature, and there's it's really smart to be part of the of their shareholder experience.
One question we get here kind of pretty frequently across all Appella, and you probably get it yourself. Every day you turn on the news, it feels like the market's at an all-time high. It's an all-time high. It's an
Yeah.
all-time high. And given kind of that first quarter dip, second quarter big recovery, strong performance across the globe, it just feels like more of the same. Like we've actually had this conversation on webinars together multiple times in the past. I'm still going to ask the question again, though. As we think about new market highs, where we are today, what does that
Yeah.
mean for tomorrow? Like how should investors with money in the market, but also cash on the sidelines, think about new market highs and what they should be doing?
Yeah, and this is so interesting because we made the point that this is a global opportunity set.
Yeah.
So, there are a lot of countries who are not even close to all-time market highs, others are. But let's focus on the US. And if you think of all-time highs, I do think that the idea of all-time highs is in our everyday life. Like today, we reached an all-time high of how many people live on this planet. How
Yeah.
many, gallons of milk we drink? How many dollars are in circulation? And we don't stop at one. That's the nature of things. Numbers get bigger. But when it comes to market, there's an anxiety that what goes up must come down. And I think that that's a good question to look at because it's an all-time high. Should I be doing something? And the answer is it depends. When you work with an advisor like Appella, they assemble a combination of different investments in your portfolio. One of them being these large companies in the U.S. stock market. And if they start hitting all-time highs and all-time highs and all-time highs, an advisor is not just going to sit there and do nothing. What they'll realize is that if I had a certain proportion that I wanted to put in the US market, and now because it's climbing to new highs and new highs, at times they might decide to trim some of these gains, take some chips off the table, and then maybe go buy something that is a better value. In other words, when the market hits an all-time high, advisors have the latitude to trim these gains through a systematic process called rebalancing.
Yeah.
So quite often these all-time high might trigger this, but that's a decision, that's a sophisticated decision that Appella makes on your behalf. The question is, because it's an all-time high, is that a sign that something ominous is coming? And maybe I shouldn't just stream, I should get completely out of the market. So to me, let's start by looking at the idea, is an all-time high a precursor of a downturn? And if you invest in all-time high, and let's say you fast forward 12 months,
Mhm.
what is likely to happen to your investments? And that's exactly what we did. We looked at this data, and we started with a time when the market hits an all-time high, and we wanted to know what happens 12 months later. So when you look ahead 1 year, is the market down, up, by how much? What's the data tell us? Not intuition, but the data, not hunches, but actual evidence. And what we see is that on average, 1 year after the market hits an all-time high, the market continues to rally. It's about 13.8 up. So quite a nice average growth after the market hits an all-time high. So there's no, sign in the data saying, "Oh my gosh, on all-time high, it's followed by a crash in the market." Not at all. In fact, it's a continued good news. Now, some could ask, well, what if I wait for some other month that it's not an all-time high? And if you invest in any other month, you still go up on average, but by not as much. It's only 12.5%. So in other words, counterintuitively, investing at an all-time high seems to be a good sign for investors. Now, this is an average. So because it's an average, does it happen every time? No. How often does it happen? It happens about 80% of the time, 81% of the time after an all-time high, you see the market continue to rally over the next 12 months. But what it is interesting is that if you look at if after any other month, it's also high, but not as high. In other words, after we hit an all-time high, not only did the market goes up more, but it goes up more consistently. Instead of 75, it's about 80% of the time that I will see it, the index is higher. Now, if you extend that to 3 years, what you see is that it's a pretty much a wash in both the chance of seeing it higher as well as the actual average. And it's kind of exactly the same when you go to 5 years. So the story here is that investing at an all-time high is not really something to be afraid of because the data does not suggest there's an imminent drop in the market. Now, for folks who are saying, well, yeah, but why don't I wait a little bit? Listen, if it makes you more comfortable to put your money to work over the next 2 or 3 months, whatever the time frame might be, it's not the end of the world. It's going to be fine. Now, this idea of trying to time the market, which means that you need to decide when to stay out, when to get back in, that's not something that would encourage clients because you have to make two correct decisions: when to get in as well as when to get out. And that's one reason that I don't know anybody who's done this consistently
Yeah.
and do it correctly. But the other big thing is that the way that business folks approach their decision making is not certainty or guarantees. In fact, our everyday life, if you work out and eat healthier, there's no certainty or guarantees. You just improve your odds of a longer lasting,
Right.
healthier life. It's the same with investing. So not too long ago, I was it was actually a few years ago by now, I was asked at a retirement community to talk more about this idea, the odds of investing. It was a group of retirees, and they would just watch the market during the day, and then they would go play tennis.
Right.
And what was interesting is that to look at the statistics of the market, and if they watch the S&P 500 like they did every single day, what's remarkable is on a daily basis, roughly about 53% of all trading days in the market are positive, and that's over the last year or the last 50 years, and 47% are not. So on a daily basis, first of all, you're going to drive yourself nuts because roughly half the days you have to know that you're going to lose money. So being in or out of the market for a day, it's not obvious that you make or lose money. You have a little bit better odds of making money, but not by a lot. Now, if you kind of extend this now and say, well, I'm going to be out for a quarter because I want to really see what's going on. Well, over the past 50 years, about 71% of the quarters have been positive and only 29% negative. So you could miss a bad quarter, pat yourself on the back and say, great, I saved money. But in reality, what are you more likely to miss, statistically speaking? A positive one. If you get out of the market, it's almost as if you sit down and you play at a table where you stand to lose 71% of the time. And we wouldn't do that. But when you get out of the market, that's exactly what happens. And the longer you stay out, the worse the odds become because over an entire year, 78% of the years have been positive and only 22% negative. And Jason, what was really fascinating is that this was about the same time when Roger Federer retired, and he's arguably the all-time best male tennis player. And I wanted to see kind of like statistically, how do you get to be the best of all time? And what's fascinating is that if you look at his lifetime career, again, not an average player, he's arguably the all-time male best player. On average, Roger Federer won 54% of the points that he played,
Yeah.
lifetime average, which is incredible because he's arguably the all-time best male player. And if you watch him play a point, it wasn't obvious that he would win it. He
Yeah.
lost roughly half the points that he played. But if you give Roger some time and you ask what percentage of the sets did he win, well, that number shoots up to 75. And if you're patient enough for the whole game, he won about 81% of the matches that he played. And
Great.
that's what I think it's interesting is that in order to be a successful tennis player or successful investor, you just have to make sure that you participate. He stuck in there, played all the points, won the big ones, and that's how he got to be a great champion. And I think it's a very similar story with investing. If you get out of the market, you basically, yes, you could miss a negative day or a negative quarter. It's just the odds are against you. And because of that, we actually think that a much better strategy is to have an advisor who has a plan, and they also have that very systematic way of triggering at times when they trim those gains as the market runs higher and higher. I just don't think it's beneficial to sell the entire thing or to just wait because that's not statistically in your best favor. And
Yeah, I
that's
love it,
interesting.
and I think that natural tendency to maybe wait if you've got cash on the sidelines to put money to work until that dip. You can wait a really long time and miss out again. So your point about dollar cost averaging, it's not perfect, right? I think lump sum will always be dollar cost averaging, but it's a good mental way
Absolutely.
of allowing money to get into the market.
If that's what it takes behaviorally, I think
Yeah,
that that's over the next 10, 15 years, I don't think you'll remember that I invested in July or August or June.
right. Yeah, yeah.
It's gonna be fine as long as you don't drag it on for too long because then the odds start to stack against you.
We've had a few people and keep putting questions into the chat, please. Fire away. We've obviously had a lot of questions, not only today, but in previous months here around these big IPOs, specifically
Mhm.
SpaceX.
Yeah.
Um, Now, I think SpaceX is one of those super interesting companies, right? Going to Mars. Who doesn't want to go to Mars? It's incredibly exciting, right? So
Yeah.
I think that the natural allure of this IPO has really kind of changed the idea of investing in IPO stocks. And we've got a few more maybe here on the horizon with Anthropic, OpenAI, et cetera.
Right.
How should investors be thinking about these can't miss IPOs, these big potential gains that are just sitting up there and just waiting to be picked? Like, how should we th be thinking about
Yeah.
SpaceX?
So what is interesting is that first of all, SpaceX, you cannot disassociate it from Elon Musk.
Right.
And I do find that as I talk to investors, he's a very polarizing figure. Some people will run and buy a Tesla because of Elon. Some people will never buy a Tesla because of Elon. So it's a
Sure.
polarizing figure, and in that respect, I don't want to get into that the politics of it and all that, but rather I do want to acknowledge something and celebrate something. And Jason, to me, I'd like to celebrate a little bit entrepreneurship
Hmm.
because it is something that we ought to acknowledge that regardless if you like him or not, the fact that an individual had the entrepreneurship, the vision to build not one but two big companies in a relatively short period of time, I think that's amazing, and that's what this country was built on, and it's fantastic to see that entrepreneurship is still alive and well. And along with that, the second celebration is on the capital markets that allowed somebody with a grand vision to grow
Yeah.
these companies to this size, and that's unique to the U.S. I'm not sure that this would have worked in any other country. And now that they are public, like you have to understand what you're buying into
Hmm.
because he started the company and initially had some people pitch in when the value of the company was not very high. And over time, more and more people bought in, but the price at which they bought in, what's called the valuation, it was getting higher and higher and higher. So by the time you get to participate in the stock market, that company has been raising money for a while, and the valuation of that company is no longer like pitching in when he's getting started and the guy needs $20 to buy a printer. That's not the case anymore. Like right now, you're buying a very big company. But it also, I want to start by, first of all, anytime you want to invest, you figure out what you're investing in. And it
Yeah.
might be worth reading sort of the first sentence in the filings that they provided to investors out there. It's called an S-1 filing to kind of really understand the ambitions of this firm and decide for yourself as an investor if that's something that is worthwhile. So their first sentence in the main paragraph under our mission, it says that our mission is to build the systems and technologies necessary to make life multiplanetary, to understand the true nature of the universe, and to extend the light of consciousness to the stars. That's what you're buying into.
Yeah.
And if you say, wow, that's a grand vision, fantastic. You're buying into Star Trek, you're buying into, really grand visions, that's fantastic. But at least know what you're buying into. This is what the company is trying to do. Now, none of that has been done so far. As far as I'm not sure that life is multiplanetary, that there is, a very ambitious project that if it works, who knows what the upside is. So the first thing is make sure that you read and dig in a little bit into exactly what you're buying. Because again, you're buying into stars and life on other planets and so forth, which is very ambitious and how worthwhile it is from an investment perspective. That's for you to decide. The
Yeah.
second thing to know about SpaceX is that when the original founders started to need more money to grow the business, they start selling perhaps pieces of the company when it was private to other investors, to their friends, to funds. And over time, you build a base of shareholders in this private entity. As the company decides to open up the ownership to the public through the process called IPO, initial public offering, they have to decide, well, what fraction of these shares of ownership that we have will we allow the public to buy? And that is
Yep.
a decision that they make. So think of a big block of cheese. It is completely up to them to decide how big of a slice from the block of cheese they decide to cut. So what SpaceX decided is that, listen, we have a lot of fans, a lot of these muskies, and we're going to slice a piece of that block. And we're going to dangle it in front of them, and then we're going to toss it out there. So what percentage? Well, it turns out that only 4% of the shares in SpaceX were available for investors at initial public offering. Only 4%. The rest are basically in a situation where the holders of those shares are in something called a lockup period, which means
Mhm.
that they are not allowed to sell for a pre-specified period of time or if certain metrics are met by the company. And that's not terribly unusual to have lockups in other companies. In fact, IPOs a month, in general, IPOs a month after they come out, about a third of the shares are available. but that's significantly more than 4%. By the time some of these lockup expires in, let's say, 6 months, that percentage increase as more of the existing shareholders can sell. And by about a year, you get 58% or so of the shares available being on the market for public investors. And as they mature and you look at the market as a whole, about 96% of the shares are available for individuals, investors to buy, and institutional investors. So what SpaceX is doing right now is basically it's a very limited supply. And this is economics 101, supply and demand. Supply is very limited because of the choice they made. We're only going to allow 4% of the shares to be sold. Now, as the lockup expire, you could actually have projections of how many more shares will be available. So by the end of September, it's estimated that 5 times as many shares will be available for purchase. 22%. By the end of the year, you're looking at 40%, almost 10 times the supply that exists today. And by the time you go a year from now, about 12 times more, about 50% of the company will be up there available for purchase by investors. So at the moment, you're dealing with a situation where it's a very limited supply. And if you ask me as an economist, I'd say that whenever there's a big supply shock, there's going to be a lot more available, unless there's a big demand coming with that. You tell me supply and demand. And right now, the supply was very constrained. And even with this very constrained supply, the stock is not shooting up. It's basically exactly where it started, roughly, last I checked. So basically no gains. It popped for a minute and then came back down. But it's not. And soon enough, you're going to have this huge supply of shares available. And all these insiders who have been locked up forever, now that they can sell, will be
Yeah.
like, oh, I need to get out. So you got to be careful with that. The second consideration is that when you look at a company, you have to decide how much am I paying for it? Because it's not just that you buy something, you have to consider how much are you paying. And the typical valuation that most investors consider is the price relative to the earnings of the company. Well,
Hmm.
SpaceX doesn't have any earnings. In fact, it has losses, billions of dollars in losses. So they're not making any money. And that wouldn't work. But another metric that investors use is, listen, if I were to buy, let's say, $1 billion in assets after all the liabilities are paid, so what do you owe after, what do you own after you pay what do you owe, sort of the assets left over, that's called book value. What you find is that in the market as a whole, the ratio is about 2.7. You'd pay 2.7 billion to buy $1 billion in assets from a company in the U.S. market. That's sort of the how expensive it is to buy the assets of a company. And it's an alternative metric to the earnings, which doesn't exist for SpaceX. Now, if you look at IPOs, they tend to be more expensive. It's about six. The ratio is about six. And when you think of SpaceX, it turns out that the ratio is astronomical. It's to the moon. It's 21. So the valuation of this company is very rich. It's basically that you're paying a lot to own a piece of this company. So what does this whole thing amount to? What it amounts to is that as an investor, SpaceX is likely going to be part of the market, but they have to consider, when do I want to buy it, in what strategies it might make sense, and how much do I want to put into that investment. And at the moment, at least the way I look at it, the first thing is, when do you want to buy it? I don't see a really compelling reason, in my personal opinion, to rush and get it at the moment, specifically, particularly knowing that there's a rush of new supply coming soon enough. So that's kind of the way that I think about the IPOs. It does make sense to own IPOs. The question is, does it make sense to own right away, or do you want to wait? And when you extend this analysis, not just to SpaceX, but all the IPOs, what you see is that over their first year, they do go up in value by about 5%. But over the same exact time period, a market as a whole goes up by about 13%. So they are a detractor of performance. The IPOs don't really add that much to the performance of an investor over the first year. So because of that, it's a matter of being very smart about when you buy and how much you buy. And that's a word the word would be flexibility. And
Yeah.
if you think of SpaceX, one of the things that they really pushed hard was to be included into indices. And why that matters, for example, is because NASDAQ, there was some money that tracked that particular list of stocks provided by NASDAQ.
Mhm.
And for them to be listed on NASDAQ, my guess is that, I mean, they kind of said, well, we're NASDAQ, why don't you add us on that list? So at that point, if you are an investor buying the NASDAQ index through an ETF or whatever, then that index is forced to buy, that investment company is forced to buy SpaceX because the committee added that to the list. And
Sure.
that's why indexing got to be so careful because they're making these decisions. NASDAQ, for example, made the decision to add it. S&P made the decision not to add it. So there, I think that you might want to have a manager, and this is kind of why I think it's important to have a manager that has a level of flexibility,
Yeah.
that they can make up their own mind. They're not being forced by somebody else to do one thing or another.
Yeah, I appreciate that. And even with that good lesson learned and observed, it'll be interesting to see what the public does with the next couple of of big IPOs here. Um,
Yeah. Yeah.
I guess the other thing too, and this is maybe just a throwaway question here as we move on to some of the larger topics. Is SpaceX kind of a company that you've seen maybe trending in the same direction as many others, where they're staying private longer versus going into IPO at an earlier stage in their development? Or are we seeing these small companies stay private longer, generally speaking?
Um, I would say that to kind of answer that question judiciously, if you look at the reason why a company might want to go public, and you look at even like companies like Disney or you name it, all the companies out there, one of the reasons that they went public is because they needed money.
Right.
They kind of tapped their banks, their friends and all that. And at some point I need to grow. And the only way for me to grow or stay afloat is to kind of invite other people to be part owners into the company, and they give me their capital, and that's how I grow or survive for that matter. And that was the case for the longest time. And over the past, couple of decades or so, what's been interesting to see is that a lot of times these companies now go public later, and maybe for a different reason. It used to be
Hmm.
the case that they went public because, hey, I needed the money, but now they don't really need the money. They're doing it because some of the existing investors who put money when they're young, when they're a startup company, they want to cash out. And then the
Right.
only way to cash out is either to find some other investor or to go public. So a lot of these companies were going public not necessarily because they needed to grow, but rather because some of the original shareholders wanted out, and there was a way to get out. So in some respect, there is this change in dynamic, but the other one is that private markets have probably supplied more to these companies to continue to grow. So yeah, could you say that they stay private longer? Yes, I do think that, well, and I don't have like tons of evidence, but my guess is
Yeah.
that they have more capital coming from private markets. Now, as an individual investor, my guess is that you don't really have as much access to that
Right.
capital. And my guess is also that when you think about this private capital, they're investing in 10 different companies. And my guess is that a number of them are going to disappear and produce nothing.
Right.
And others will maybe chug along, and maybe one or two other moonshots are going to make them a lot of money. It's just that it's not obvious when you invest. So if you invest in these private equity, you have to be fully diversified. And the results of this, when you include all the ones that don't make it, are not as shiny as most people think.
Yeah. No, I appreciate the perspective. Um, let's take a hard left turn now and let's start talking about the Fed and inflation. So, new Fed chair, maybe we've seen some sparks and pressure again of some renewed inflationary pressure here.
Yep.
Um, we've also, I don't want to get too political here, but
Yep.
maybe our president has put some pressure
Yep.
on the Fed to lower interest rates. How do we think about this from a historical standpoint? How do you kind of see the Fed adjusting and maybe, I guess, give us your prediction on interest rates? Now, you don't have
Yeah.
to do that, but just kind of curious your
Yeah.
perspective of what that, the Fed independence, pressure, and interest rates look like here in the face of a lot of things going on in the world.
Yeah, and Jason, I mean, I've been getting this question quite a lot lately, and what I found interesting is to kind of go a little bit and provide some perspectives on the Fed itself, where it
Yeah.
came from, how we got here, because there are some important lessons from there. So if you go back to the origins of the Fed, it goes back to the early 1900s when bank crises were solved by pretty much like J.P. Morgan. He would bring in bankers into his office, lock them up, and say, "Hey guys." Mostly guys at the time, you're not getting out until you fix this. So that was the way that banking
Mhm.
problems are solved. And there was a realization that he's not going to live forever. So what happened was in 1913, we established the Federal Reserve. And the idea was to regulate banks and help with these financial situations that they might come from that sector. And at the time, the Treasury Secretary was involved, and he was at the leadership of the Federal Reserve. And soon enough, politicians realized that this idea of what the Fed does called monetary policy ought to be independent. So the decisions they make about the money in society should not be tied into a political party. So in 1935, the Banking Act was introduced, which sets the foundation for the Fed as we know it today. So what's important about the Banking Act? They really try to insulate the Fed and make sure they make decisions based on economists' belief on what's right for the country. So what they did is they said, okay, so we're going to have seven different governors, and these governors will be appointed by the president, but also confirmed by Senate. And they're relatively long term, so it's not just one president, but you might have governors coming from different presidents. And on top of that, we're going to have 12 regional banks, and there are 12 Federal Reserve banks across the country. And out of those, five of them on a rotation basis will go along with these seven governors and form a committee of 12 called the Federal Open Market Committee, FOMC. And this group of 12 will vote on what the policies will be of the Fed. So even though you hear so much about the Fed chairman and all that stuff, he's one of the 12. He's the one that probably is the most public because he testifies in
Mhm.
Congress and he might have a little more influence. But the reality is that five of those members are from regional banks that have nothing to do with the president or nothing to do with anything. Some of the governors are appointed by the president, and they have all a mind of their own. So not like when people say, "What is the Fed chairman going to do?" It's not about the Fed chairman. There are 12 votes, and these folks have a brain of their own. They're not going to fall in line just because Kevin Warsh tells them to do something. And it turns out that during World War II, there was a bit of collusion between the Treasury and the Fed, just because it cost a lot of money to fund the war. So to kind of make sure that we don't get crushed by the debt, the Fed did help the federal government,
Mhm.
the executive branch, with the borrowing. But in 1951, there was a landmark memo that the Treasury put out saying, okay, as of today, we kind of completely will have our hands off Treasury. We have nothing to do. They're going to be completely independent. And the Fed chairman, his name was McChesney Martin, and he was the one who basically was part of this accord. However, not long after, he was still he was still the chair of the Treasury, of the Treasurer of the Fed, when Lyndon Johnson famously called him at his farm in Texas and kind of almost pinned him against the wall, supposedly asking him to lower rates. So the president did significantly try to say, "Hey, listen, go influence the other members and make sure you deliver some rate cuts." And McChesney Martin basically stood his ground and said, "No, I'm not going to do that. I'm going to use my judgment into the right policies for interest rates." And he did not. He stood up to
Mhm.
LBJ and did nothing. And at the same time, not long after, Nixon also tried to do the same thing with Burns, who was the Fed chairman at the time, and it was a lot more successful than LBJ. And once again, it was a case when a president really tried to influence the Fed policies, and in this case, it was a lot more successful than LBJ was McChesney Martin. But what we had were, the 70s, which were high inflation and economically terrible. And in 1979, a new Fed chairman by the name of Paul Volcker came along and he said, we need to reestablish the Fed independence. And he fought for the Fed to be fiercely independent and said, no more monkeying around. And for all these years, for 40 plus years, that's exactly the type of Fed that we had, fiercely independent, up until we had the latest spat between Chairman Powell and President Trump. Now, again, if you look at the history that this context, there are two things that jump at me. The number one thing that jumps at me is that it's not really unprecedented when you say, oh, it's the first. No, it's not. I mean,
Yeah.
we've seen this in the past. And number two is that there is a built-in mechanism which has to do with the Federal Open Market Committee, the rotation of the regional banks. So it's not like, like there are no checks and balances. There is a lot more than people think. So because of that, I want to just take a step back and just reinforce to folks that as much as you hear, you have to distinguish myth from reality. The second thing that I need to talk about is that when you look at interest rates, all interest rates are kind of put on the back of the Fed. Oh, the Fed, what's the Fed going to do? Today, actually since 1979, the Fed has had two different mandates. One is we want price stability in the country. The
Hmm.
second mandate is that we want good employment. We want the economy to be strong. And sometimes the two of them are butting heads. They're not aligned. For example, growing the economy might mean cut rates, but cutting rates might actually mean higher inflation. And
Right.
today, in fact, or yesterday, the chairman of the Fed reiterated that the Fed's priority among these two objectives is inflation. And that's good news because what it means is that if you want to stop prices from going up, you can't really cut rates and encourage consumption. At the same time, Jason, if you look at the interest rates in the economy, there's some short-term interest rates which have to do with certificate of deposits at the bank or how much you pay as a business to borrow overnight so you can make payroll. So these very short-term rates, and these are the ones that typically the Fed controls. So if you look at this year, what you see is that the federal funds rate, which is a very short-term borrowing rate, are unchanged. So the Fed made no moves whatsoever with respect to rates. Again, because inflation is a priority, and if they were to increase or if they were to decrease rates, it would mean perhaps higher inflation, and especially after the war, that didn't seem very smart. They also didn't increase because they don't want to hurt the economy. So they just stayed very flat. On the other hand, there are some longer term rates. For example, 10-year rates, not 30 days or a week rates, but 10 years. And if you look at those rates, what's fascinating is that fluctuated tremendously, even though the Fed made no moves. So, over a few short weeks, we had a 0.7% increase in these long-term bonds, even though the Fed made no moves. So what it appears to be the case, and this is what the evidence shows, is that these longer-term rates, they're not really driven by the Fed, but multiple variables. And one of the most important one is what is the expected inflation? Because if
Hmm.
I'm going to give my money for 10 years, I want to at least be able to buy the same things. And as the war started, gas went up, prices went up, inflation went up. The expected inflation over the next 1, 2, 3, 5 years also went up. And when that happens, these interest rates go up. And it's not the only variable, but this is one of the really important ones. And to me, when you think about inflation, yes, it's not only about the price you pay at the pump. It's not only about the eggs and the groceries. It's not only about the clothing. It's also about the interest rates on these longer term bonds. And the reason that these are so important is because if you look at the long term trend in these 10-year treasuries, in the 10-year government bonds, and you overlay the mortgage rate, they clearly appear to be
Yeah.
connected. So it's not so these mortgage rates that you hear so much about, they're not controlled by the Fed, but rather they're much more connected to the 10-year rates, and those 10-year rates are more connected to inflation. So the long story here is the Fed has to balance these two competing objectives. Do I want the prices to stay stable, and then maybe I want to raise rates? On the other hand, I don't want to hurt the economy. And so far, the Fed has been signaling that let's just stick around with what we have right now with rates, but those are only short-term rates that might impact the CDs that you get at the bank, or they might impact the overnight borrowing for some companies. However, the inflation had a much bigger impact on the longer term rates, which in turn translate to your mortgage.
Yeah, it's really interesting. I appreciate that perspective. And I hate to leave on a bang here. We've got maybe 7 or 8 minutes here left to finish up, and I'm gonna take another hard pivot into politics, a little bit
Yep.
deeper into politics, as you know, fast approaching midterms.
Yep.
Um, what should investors be thinking about around these midterm elections, the kind of the potential to reshape what the agenda looks like in Washington? What's the impact of investors' portfolios? How should investors be thinking about it? Should we be ignoring it? What's your perspective on the midterms here?
Yeah, I mean, the first perspective is that midterms and politics in general, it tends to be a very emotional issue because it
Sure.
touches on our deeply held beliefs, our core identity as individuals, and because of that, it triggers those strong emotions. And I think it's perfectly fine. I think it's amazing. It's That's what makes us human, and I think that you ought to act on those emotions the right way. You have to get involved and vote and do the things that align with your values. When it comes to investing, what I always cautious folks is to acknowledge the emotions and at the same time disentangle them from investment decisions, and make sure that those decisions are not based on how you feel, but rather much more on the data. What does the data suggest when it comes to midterms? So before we get to the data, one quick note is that when you're buying ownership into these companies, and whether it's Amazon, Google, McDonald's, Coca-Cola, all these companies that we know and love, their value in the market depends on how much money are they expected to make for years and years to come. So the question then the market's answering is how important is this variable, the midterms, in the grand scheme of things? Like this year, there is the war. You had price of oil. You have AI. That's the my impact opportunities. You put midterm elections. Is midterm election a very strong? Is that a strong enough predictor of what the market's going to do that you find a pattern in the historical data? So when we did this analysis, and in fact, we went back to 1950 and look at every single midterm election. And there were times when you did see that it went from Republican to Democrat. I have no idea what's going to happen this year, but there were two instances in previous midterms when Congress went from Republican to Democrat. Now, although there are also a lot more times when it stayed Democrat, there are times when it went from Democratic to Republican. There are two times when it stayed Republican, and there are also times when it got split. So it's all over the place. You kind of see all kinds of outcomes. Now the question is, is there something special, particularly about November, that month of the election? Because the conventional wisdom, the story goes that, hey, there's a lot more uncertainty and the markets don't like uncertainty, blah, blah, blah. Is that what we see in the data? And is there a way to connect what happened to the different patterns of either staying Democrat, staying Republican, split in any sense? So when you go back to the 50s and you look at November, that particular election month, what's so interesting is that in most cases, not all cases, but in most cases, the market does go up in the month of the midterm. And the two cases when it didn't was 1974 and 1994. So in 94, it went from Democrat to Republican, and in 1974, it actually stayed Democratic. So in this case, it's not clear that the Congress constituency really impacted that clearly. But that was the month of the election. The question is now, if you fill in the gap with the rest of the 11 months of the year, what do you see 1 year ahead when you add the 11 months? And this is where it gets so interesting. After the election, if you look at the next 11 months, in every single instance, following the midterms, the S&P was positive. And in fact, in those 2 years, the 74 and 94, when they were negative, during the month of the election, in both of those, the market went up by over 30% over the following 11 months. So nobody can tell you what's going to happen this November or the next 11 months. What's interesting to me, Jason, is that the data does not seem to suggest something really ominous that, hey, be careful because the market tanks after the mid. Not at all. In any kind of iteration that you look at, The market could drop in November. Don't read too much into it
Yeah.
because over the next 11 months, in every single case, it actually was positive, which is quite remarkable to see that it's pretty much every single instance. So because of that, stick to the plan. That's the best strategy. Stick to the plan and don't make decisions based on the election because there are too many other variables that impact the market performance beyond the constituency of Congress.
Well said. Couldn't agree more. As a planner myself, at a firm of planners, we believe in sticking to the plan. Um, we covered a lot today, and I certainly appreciate it. We have a million more questions that we could keep you on here for probably another 3 hours. But I know in the interest of your time and beauty rest, we'll say goodnight here. But
It's
we
dinner
very
time
much.
in on the East Coast. It's dinner time. So who won the game
We
today? Who won the game? Do you know? I mean, I hope somebody knows.
no, no,
Maybe they can put in the chat.
exactly. If somebody knows who won, feel free to throw it in the chat. No, I actually have not looked, but hope the team that everybody was rooting for won. Um, Appreciate this very much. We look very much forward to the next time you come join us, and I guess the next time you join us will be kind of at the 2026 year in review, where we'll actually have new data on what happened post midterms
Yeah.
here, at least a couple of months worth of data. So very excited to have that chat with you. As always, we appreciate everything you bring to the table, your partnership, your friendship. Thank you so much. Thank you to everybody who tuned in tonight. Like I said, the recording will be up at some point next week. Please share it with family, friends, coworkers, loved ones. We want to help as many people as we can. To everyone on this call, thank you again. Good night. Apollo, thank you one last time. We appreciate you.
My pleasure. Great seeing you. Bye bye.
Take care.